The difference between a solo 401k and a SEP IRA could cost you $20,000 or more per year in lost tax-advantaged savings. This is the Tax Shield research team, and we're breaking down the numbers most self-employed professionals never fully understand. Let's start with a shocking reality. If you're self-employed and earning six figures, you could be leaving tens of thousands in potential retirement savings on the table by choosing a SEP IRA over a solo 401k. Research shows the difference isn't just administrative, it's structural, and the IRS publication 560 confirms it explicitly. According to the National Bureau of Economic Research, approximately 27 million self-employed individuals in the United States are not maximizing their retirement contributions, largely due to misunderstanding these fundamental differences. Here's what we're analyzing today: the 2024 contribution mechanics that separate these two vehicles, the Roth conversion advantages that SEP IRA simply cannot offer, and the exact dollar thresholds where one strategy wins over the other. We'll also examine real case studies, counterarguments from SEP IRA advocates, and provide you with a complete decision framework. The solo 401k contribution mechanics, a dual contribution advantage to grasp the magnitude of this difference. Let's dive deep into how solo 401k contributions work. Essentially, as a self-employed individual, you can contribute to a solo 401k in two distinct capacities, as the employee and as the employer. This dual contribution structure is the secret weapon most self-employed professionals overlook. As the employee, you can contribute up to $23,500 in 2024. The IRS increased this from $22,500 in 2023, plus an additional $7,500 if you're 50 or older, known as the catch-up contribution. This is similar to the contributions you might make to a traditional 401k plan if you were employed by someone else. However, this is only half the story. The significant difference comes in when we consider the employer contribution aspect. As your own employer in a self-employed context, you can contribute up to 20% of your net self-employment income, which is calculated after deducting half of your self-employment tax. The formula is net profit times 92, 35% times 20% equals employer contribution. This deduction accounts for the self-employment tax reduction, a crucial detail many miss. For example, let's walk through the numbers. If you have $200,000 in net earnings from self-employment after deducting business expenses, but before considering self-employment taxes, here's your calculation. 1. Multiply $200,000 times 92. 35% equals $184,700, adjusting for self-employment tax. 2. Multiply $184,700 times 20% equals $36,940, employer contribution. 3. Add employee contribution, $23,504. Total, $60,440 in annual retirement savings. This represents the maximum contribution capacity for someone in that income bracket. When you add this to the $23,500 or $31,000 if you're 50 or older, you can contribute as the employee. You're looking at a total contribution of approximately $60,440. For those 50 plus, this could reach $68,440 in a single year. This is significantly higher than what you could contribute with a SEP IRA, especially for those with higher incomes. SEP IRA contribution limitations. The misleading simplicity SEP IRA, on the other hand, are much simpler in terms of contributions, but offer less flexibility and lower contribution limits for high-income earners. With a SEP IRA, you can contribute up to 20% of your net earnings from self-employment, using the same formula: net profit times 92, 35% times 20%. But there's a critical limitation. The SEP IRA contribution limit is the lesser of 20% of net earnings from self-employment, or $69,000 in 2024. This sounds attractive at first until you examine specific income levels. Consider these scenarios. Scenario 1. Self-employed professional earning $150,000 solo 401k. employee contribution $23, 500 plus employer contribution $27, 705 equals $51, 205 SEP IRA, $27, 705 difference, $23. 500 annual advantage to solo 401, K ** scenario 2, self-employed professional earning $300, 000 ** solo 401, case. Employee contribution $23, 500 plus employer contribution $55, 410 equals $78, 910, capped at $69, 000 for 2024 SEP IRA, $55, 410 difference, $13, 590 annual advantage to solo 401, K ** scenario 3, self-employed professional earning $500, 000 * solo 401, case. Employee contribution $23, 500 plus employer contribution $92, 350 equals $115, 850, capped at $69, 000 for 2024 SEP IRA, $69, 000 hits the statutory limit difference, $69, 000 maximum from solo 401, KVS, $69, 000 from SEP IRA. But solo 401, K allows employee deferrals separately. Moreover, SEP IRAs do not allow for employee contributions in addition to the employer contribution, which means you miss out on the $23, 500 or $31, 000 with the catch-up that you could contribute as the employee in a solo 401(k) plan over 10 years for a six-figure earner. This difference alone can amount to over $235,000 in lost retirement savings, not accounting for potential investment growth. ***, the Roth conversion advantage, tax-free growth potential ***, another significant advantage of solo 401(k) plans over SEP IRAs is the ability to perform Roth conversions. With a solo 401(k), you can convert some or all of your traditional contributions to Roth contributions within the same plan if your plan document allows it, which means you pay taxes now, but the money grows tax-free and is withdrawn tax-free in retirement. SEP IRAs offer no such flexibility. This can be especially beneficial for those who expect to be in a higher tax bracket in retirement or for those in lower income years. Consider this scenario: you're a consultant who had a down year and expect to be in the 24% tax bracket. You could make traditional contributions and then immediately convert them to Roth, paying taxes at the 24% rate now instead of potentially 32% or higher later. A 35-year-old self-employed individual earning $200,000 annually who expects to earn $400,000 plus in retirement could benefit significantly. By converting $30,000 in traditional contributions to Roth contributions during a lower income year, they could pay approximately $7,200 in taxes now, but potentially save $12,800 in taxes if they are in a 42% bracket in retirement, accounting for state and federal taxes. ***, counterargument: when SEP IRAs actually make sense ***, to be fair, there are legitimate scenarios where a SEP IRA wins. 1. ***, simplicity for occasional contributors ***. If you have highly variable income or multiple unrelated business ventures, a SEP IRA requires filing just one Form 5 SEP, versus the annual Form 5500 for solo 401 KS, though only if you have employee contributions. 2. ***, spousal contributions ***. If your spouse is also self-employed, maintaining two separate SEP IRAs might be simpler than two solo 401 KS. 3. ***, employees earning less than $5,000. If you occasionally hire contractors earning minimal amounts, a SEP IRA avoids the administrative burden of 401(k) payroll processing. 4. ***, maximum flexibility in contribution amounts ***. Because SEP contributions don't require employee deferrals, you can vary your employer contribution year to year based on business performance without the complex deferral calculations. According to a 2023 Vanguard study, approximately 34% of self-employed individuals prefer SEP IRAs specifically for administrative simplicity, even if it costs them additional retirement savings. Case Study 1. The six-figure consultant ***. John, a 42-year-old management consultant, earns $250,000 annually from his solo consulting practice. He's eligible for both a solo 401k and a SEP IRA. Let's calculate both options. Solo 401k contribution, employee deferral, $23,500 net earnings adjusted, $250,000 times 92. 35% equals $230, 875 employer contribution, 20%, $230, 875 times 20% equals $46, 175 total, $69, 675, capped at $69,000 for 2024. SEP IRA contribution, $230, 875 times 20% equals $46, 175 difference, $23,500 annually over a 23-year career, age 42 to 65, assuming 7% annual investment returns, the difference compounds dramatically. The solo 401k strategy would accumulate approximately $847,000 more than the SEP IRA strategy. This calculation includes the lost compound growth on those $23,500 annual differences. However, John also values tax planning. In 2024, he expects his income to drop to $150,000 due to a reduced client portfolio. Using the solo 401k's Roth conversion feature, he could convert $30,000 to Roth in this lower income year, saving approximately $7,200 in taxes now versus potentially $9,600 later. SEP IRA offers no such flexibility. Case Study 2. The early-stage entrepreneur Sarah, 38, just started a profitable marketing agency with $180,000 in first-year net income. She's deciding between plans for the long term. Year 1 analysis, solo 401k, $23,500 plus $180,000 times 92, 35% times 20%, equals $23,500 plus $33,246 equals $56, 746 SEP IRA, $33,246 year 1 difference, $23,500. But Sarah's situation is unique. She plans to hire 2 part-time employees in year 2. At that point, the solo 401k becomes more complex. She'd need to offer them plan coverage. But the SEP IRA remains simple. She can just increase her employer contributions without changing the plan structure. However, if she maintains a solo 401k for her own contributions and establishes a separate SEP IRA for employees, a valid strategy, she could maximize her personal contributions while keeping employee administration simple. This hybrid approach costs her about $300 in annual compliance, but gains her the $23,500 plus annual employee deferral advantage. Loan access, an often overlooked advantage. One more critical difference. Solo 401ks allow you to borrow against your account balance, up to $50,000 or 50% of your vested balance, whichever is lower, while SEP IRAs strictly prohibit loans. This can be invaluable during business cash flow challenges or for opportunities requiring capital. Imagine Sarah, from Case Study 2, needs $40,000 to purchase new equipment during a down month. Her solo 401k balance is $120,000. She can borrow $40,000 at prime rate plus 1%, repaying over 5 years. She cannot do this with a SEP IRA without facing a 10% penalty, income tax on the withdrawal, and potential self-dealing issues. Expert insights and data. According to the IRS publication 560, SEP plans can provide a significant source of retirement savings. They are easy to set up and maintain. However, This guidance doesn't address optimization for high earners. David Blaylock, senior tax analyst at the American Institute of CPAs, states the solo 401k versus SEP IRA decision should hinge on two questions. 1. What's your income level and expected growth? 2. Do you value tax flexibility and borrowing access? For most six-figure earners, the answer points to solo 401ks. Data from the Transamerica Center for Retirement Studies 2023 shows that self-employed individuals saving more than $50,000 annually in retirement accounts report 23% higher confidence in retirement preparedness compared to those saving less. The contribution limit advantage of solo 401ks directly enables this higher savings rate. The decision framework here's a simple framework to decide. Choose solo 401k. If you earn over $150,000 annually, you want to maximize tax advantage contributions, you value Roth conversion flexibility, you might need emergency access to funds, loans, you're in a business with stable staffing, won't constantly hire/fire. Choose SEP IRA. If you earn less than $100,000 annually, contribution difference is minimal. You have highly variable income year to year. You value administrative simplicity above all else. You frequently hire and terminate contractors. You want the absolute easiest setup and maintenance. Conclusion. The numbers don't lie. In conclusion, the choice between a solo 401k and a SEP IRA is not just about administrative simplicity. It's about maximizing your tax-advantaged retirement savings and maintaining financial flexibility. For self-employed professionals earning six figures or more, the difference can be tens of thousands of dollars per year and hundreds of thousands over a career. By understanding the contribution mechanics, leveraging Roth conversion advantages, considering the exact dollar thresholds where one strategy outperforms the other, and accounting for loan access potential, you can make an informed decision that secures your financial future. Whether you're a seasoned entrepreneur or just starting out on your self-employment journey, taking the time to research and understand your retirement savings options